So Roger, we talked for so long about when the Fed was going to raise interest rates, and they've taken the first step in normalizing interest rates. So what do we expect now?
Yeah, that's right, Nani. After the December lift-off, the focus it's going to be, of course, on what's next. We've been saying even before December, right? I mean, the path will be a gradual path of rate hikes and normalization of monetary policy. We expect that as basically we see more data coming in, confirming that the U.S. economy is coming along at a good pace, not super optimistic, but with job market remaining strong, and particularly if we see inflation normalizing. This is really what Fed officials and FOMC members are looking for, some sense of normalization in inflation metrics. Then we could see rate hikes at a very gradual pace, say once every other meeting, at 25 bips or something like that. Now, what is distinctive of our view on the Fed for 2016 from Vanguard, I would say, is that what we do expect that at some point later in the year, the Fed would step back and assess how those rate hikes are working for the U.S. economy. There are a number of things they need to see and to evaluate, like, for example, what is happening to the U.S. dollar as monetary policy globally is diverging. They also need to announce what they are going to do with the balance sheet that they have right now, the $4.5 trillion, right? And they may decide to announce this stop of reinvestments in terms of treasuries and mortgage-backed securities. And that all those things would require some sort of pause in the pace of rate hikes. So this is something that even from last year we've been talking about, a pause of around 1% more or less for the rest of the year. So very gradual pace up to a certain point in which probably they will need to assess and pause for 2016.
I think it's a very high likelihood that the Fed will be hard-pressed to raise rates beyond, say, 1% over the next 2 years. And it's not because we're very bearish on growth, right, Roger? It's because the world, I think, will increasingly struggle with Fed policy that globally leads to additional further appreciation of the dollar, and other parts of the world that are still undergoing this sort of structural rebalancing that we've talked about for some time. So again, I wouldn't read my comments as overly bearish on the U.S. economy, but to Roger's point, I couldn't agree more with. There will very likely be an extended pause in policy. It's either because growth accelerates and you have to think about tapering their balance sheet, or more likely significant deceleration in U.S. growth, and or an assessment, let's take time because policy does work with a long lag. And because of that, we still maintain that there will not be a strong upward pressure on long-term interest rates and bond yields, because the policy is just removing, even if they go to 1%, just removing some of those excessive measures we had, rather than it's not a traditional tightening cycle in the way that the easing cycle was not traditional either.